For the last 72 hours, silver hasn't been trading. It's been fighting. Because what you're watching on the chart doesn't look like normal price discovery. It looks like a line in the sand defense, fast, violent, and way too precise to be random. And that line is $92. Here's the part that should make you sit up. Every time silver gets its head above that level, the market doesn't drift. It gets hit hard. Not a slow wave of people dumping coins. Not miners hedging. It's the kind of sudden, high-speed selling that shows up when someone's trying to cap a number. Not find equilibrium. If you pull up Thursday's action, January 15, 2026, you don't see a market calming down. You see something closer to a crime scene. Repeated, coordinated bursts designed to shove price back under a solvency level the system can't afford to let stand. So let's do this the right way. Let's reconstruct the timeline, because the timeline is where the story gives itself away. Early morning, silver rips higher. It prints around $92.23. Momentum is basically vertical. Buyers are stepping on the gas. And for a minute it looks like we might punch straight toward $100. Then, right on cue, the hammer drops. In minutes, a massive wave of paper selling slams the Globex market. Not physical liquidation. This is algorithmic shorting contracts. Not metal, dumped fast enough to shock the tape. Price gets smashed from $92 down to roughly $86.20 in the blink of an eye. And immediately, the headlines hit: silver crash, bubble bursting, smart money is exiting. But here's the question they're not asking. If this was a real sell-off, why did it feel like a perfectly timed ambush at one exact level? And why did buyers show up the second the selling paused? This wasn't a pullback. It was a battle. And the battlefield has a number stamped on it, $92. If you think silver just moved, you missed the point. What happened looked less like price discovery and more like a coordinated defense of a line the system simply cannot let stand. Call it a crime scene. Call it a battlefield assessment, either way. The footprints are everywhere. The speed of the hit, the precision of the timing, and the way the market kept snapping back like something underneath refused to stay buried. Here's the question nobody on mainstream TV wants to ask out loud. Why $92? Why does everything get calm below it, then instantly turns violent the moment price dares to poke its head above? Because $92 isn't just a price, it's a pressure point. A level where the paper game stops being manageable and starts becoming existential. If silver can hold above $92 going into options expiry, the story shifts. It's no longer a trading problem you can smooth over with volatility and headlines. It becomes a solvency problem, the kind that forces hedging, forces buying, forces mistakes, and exposes who's been leaning on virtual supply a little too hard. So the system does what it always does when cornered: it fights dirty, fast, and loud, hoping you flinch, hoping you hand over your position, hoping you mistake a manufactured scare for reality. But here's the creepy part. The more violent the defense gets, the more it reveals the truth. Because if $92 meant nothing, they wouldn't be acting like it's the last door between business as usual and a full-blown reset. And once you understand why $92 matters, the tape suddenly reads like a confession. Because what happened next wasn't a normal dip. It was a rapid-fire timeline that looked engineered down to the minute. Silver pops to around $92.23, just long enough to make that level visible. Then it gets hammered to roughly $86.20 in a blink. Not a slow slide, not a wave of people selling bars and coins. This was the signature of paper selling, algorithmic pressure that appears out of nowhere, hits like a sledgehammer, and tries to create instant panic before anyone can think. And right on cue, the headlines roll in: silver crashes, bubble pops, the usual script. But here's where it gets interesting, because the market didn't behave like a real crash. It snapped back, hard. Buyers stepped in at the lows and shoved price right back toward $90 to $91. Like the sell-off was a trapdoor and demand was waiting underneath it. That rebound is the part you're not supposed to focus on, because it raises an uncomfortable question. Who is buying that aggressively if the story was everyone's getting out? Then comes the part that makes the whole thing feel less like chaos and more like choreography. A second hit, a double tap, right as silver approaches $92 again, knocking it back down into the high $80s. Up, down, same ceiling, same violence, same message. Don't look above this line. That repeated whiplash is the smoking gun. It doesn't prove weakness. It proves a tug of war, physical demand trying to pull price higher, and paper suppression trying to slam the door shut at the exact moment the market tests the level that matters most. Now connect the dots. That double tap near $92 wasn't emotion, it was risk management under panic. Because $92 isn't just a psychological number. The script argues it's where a massive options call wall and stacked derivative exposure sit like dry tinder. And here's the part most people miss. Options don't just react to price, they can force price. If silver settles above $92 into expiry, dealers and banks can't shrug it off. They have to hedge. Hedging means buying. Buying pushes price up. Higher price forces more hedging. And suddenly you're not watching the market move, you're watching a feedback loop start to spin. That's why the selling looks so desperate. Not strategic. Desperate. Like someone burning furniture to keep the house warm. Anything to avoid the one outcome they fear. A close above the line that triggers mechanical buying they can't control. And this is the key takeaway. The volatility isn't random noise. It's engineered around a single pressure point where even a small step higher could flip the situation from manageable to catastrophic. So the real question isn't, why is silver volatile? The real question is, how much paper pressure are they willing to throw at $92 before the hedging math takes over, and the market stops listening to fear? And if that's the why behind the violence at $92, then the next question is unavoidable. How do they even pull off a smash like that in the first place? This is where the script goes under the hood, and what you find isn't pretty. The sell-off isn't framed as people dumping physical silver. It's framed as naked short mechanics, selling futures promises without the metal. Injecting instant virtual supply into the market. On paper, it looks like supply just exploded. To an algorithm, that's all it needs. Price ticks down. Momentum flips. Stops get tripped. Headlines get written. And suddenly fear is doing half the work for free. And that's the playbook the script says worked for decades. Print a wall of contracts. Shock the market. Scare the weak hands. Then quietly buy it back cheaper once the dust settles. It's not conspiracy vibes. It's incentives. If you can create the illusion of supply, you can temporarily control the quote. But then it drops the metaphor that changes the whole picture. The beach ball underwater. You can push it down, but the pressure builds. Physical reality, industrial demand, inflation, and that stubborn global pricing signal keeps trying to force silver back up. And the more they press, the more force they need to maintain the illusion. That's why the rebounds are so fast when the paper selling pauses. It's like the market is telling you, in real time, this is where the price wants to be when the thumb comes off the scale. So here's the curiosity hook. If the virtual supply trick is losing power, what happens when the market finally stops believing the paper quote at all? And here's the forensic detail that makes the beach ball theory feel less like a metaphor and more like evidence. Open interest didn't collapse during the smash, it climbed. In a real washout, when everyone's panicking and bailing, you usually see open interest drop. Positions get closed, longs capitulate, the market clears, but the script points out something weird. As price got slammed, new buying absorbed the dump. That suggests the selling wasn't meeting a vacuum, it was meeting a bid. And not just any bid, the kind that shows up when bigger players smell an opportunity. The implication is blunt. Paper shorts are being met by physical longs, participants using futures not to gamble, but to secure delivery. And that flips the script on the banks. Every contract they fire into the market to push price down doesn't just lower the quote. It potentially becomes a delivery liability sitting on their books, at a moment when sourcing real metal at those prices is portrayed as fantasy. Shanghai trades higher. Street premiums stay firm. Mining supply can't magically ramp overnight. So if the metal isn't available where the paper price claims it is, what's the real goal? The script says it turns psychological. Scare physical holders into selling back. Because intimidation is cheaper than delivery. And that leads to the question you can't unsee. If open interest rises into the smash, who exactly was buying the fear? And if you're still wondering who was buying the fear, the script says, stop staring at New York for the truth. Look at the lie detector. Because while the US paper market was dumping contracts and screaming, crash, Shanghai was trading near $100. That's not a cute little spread. That's a $13 plus premium, a gap so wide the script calls the US drop mathematically illegitimate. Because a real global commodity doesn't split into two realities unless something is broken. Shipping, insurance, and handling don't explain a difference that big. So the question becomes brutal. If silver is really $86 to $90, why is one of the biggest physical hubs on Earth paying closer to $100? The script lays out the uncomfortable logic that follows. If the spread is real, it invites a basic arbitrage pressure, cheap paper in the West. Demand delivery, move physical into the higher-priced market. And when that logic starts making sense to enough participants, paper suppression stops being a clever trick and starts becoming a supply chain problem. Then it goes deeper into the why. China's demand is portrayed as inelastic, solar build-outs, EV supply chains, industrial throughput that can't just wait for a dip. They pay up because the metal is feedstock, not a trade. And the punchline is chilling. The script suggests a shift from just-in-time buying to stockpiling. If that's true, then Shanghai isn't reacting to New York, it's front-running it. So after the Shanghai lie detector, the script lands on the real endgame. What happens when $92 doesn't hold them back anymore? Because at that point, the line doesn't break down. It breaks upward. And that's when the mechanics flip from intimidation to